A lot of folks are freaking out about the auto market because you've got platforms like the Financial Times saying an auto lender's bust signals strain in the financial health of U.S. households. And they're making this argument that, hey, the collapse, the sudden, quote, messy collapse of Tricolor, where banks like JP Morgan and Barclays are potentially losing hundreds of millions of dollars, came as a shock, and maybe it's a sign that households are much weaker than we think. I mean, this comes as we've already been seeing articles like this, where here we've covered this a few months ago, where cars are so expensive that buyers now need 7-year car loans. And if you look at the chart of the change over time of financing arrangements that car buyers have been using, you can see the black line, which is the 5-year line, has fallen from 50% of car loans being 5-year loans in 2005, 20 years later down to less than 10%. Actually, that's probably about 18%. Yeah, less than 20%. Whereas what's happening at the same time is 7-year car loans, which used to represent 1.8% of the market, have risen to over 20% of the markets. Share. Now, it's understandable. Like, yes, households are getting squeezed. Rates are high, so we extend loan terms not just on cars, but you're also seeing extended loan terms on housing with now 40-year interest-only loans with amortization periods built in and fixed rates built in being sold to try to create some private market competition to the Fannies and Freddies of the world who are doing your traditional 30-year fixed. Okay. It's understandable. When rates are high, this is what happens. So yes, there is consumer stress amongst the, sadly, lower 50% of American households. This we already know. But is it really a sign of the financial health of the broad set of U.S. households that Tricolor all of a sudden went straight to bankruptcy, which mind you is very unusual for a company with potentially $1 billion of debt or over $1 billion of debt and 25,000 different creditors to go straight to bankruptcy. In fact, that's, Bloomberg has a whole piece on this. They talk about personal items are locked away in Tricolor's facilities, unusual nature of a subprime auto lender going straight to Chapter 7 liquidation. And they have a whole article basically about how unique this is. Well, at the same time, of course, you also have companies, like the Wall Street Journal reporting an exclusive here yesterday that Ford is courting riskier borrowers with lower rates for F-150 pickup trucks. Keep in mind, Tesla is doing this as well. Tesla's doing like 0% financing. If you're a repeat customer, they'll give you $1,000 off. You'll get the tax credit. Like, these companies are doing everything they can right now to throw sales up. And it makes sense. I think it's partly one of the reasons why Tesla is so high right now as markets are pre-anticipating really, really good delivery numbers for Tesla. Potentially the best delivery numbers that we've seen in the last 3 years. Like going back to 2021, these could be the best delivery numbers for Tesla because of that massive $7,500 expiring tax credit on September 30th, which is in 6 days. So it totally makes sense to me. But anyway, take a look at this. Ford is racing to sell more F-150 pickup trucks this quarter by offering lower interest rates to borrowers with the weakest acceptable credit histories. This is where we start walking down a dangerous path, and you're going to see some crazy insights here in just a moment on Tricolor on, maybe this wasn't exactly a larger financial health issue, but potentially more of an immigration and a targeted ignorance and maybe even fraud bankruptcy. We've got to talk about that. Just remember, though, my commentary and financial analysis on a lot of these companies, including what we think about timing regarding Tesla stock price, what's going on with the Qs, price targets on lending-related stocks over the next few weeks versus the next 6 months, or even price targets on NVIDIA. If you want to get these, make sure you're part of that Meet Kevin membership. You can use coupon code, we've got it here, Daddy's Back. Use coupon code Daddy's Back and join that Meet Kevin membership. Keep in mind what you get with that membership membership is you get the top 10 stocks to buy for the next 10 years. Those are the long term. That's in addition to shorter term trades. You get private live streams, trade alerts, alpha reports every single morning. The market is open, all 8 courses, and the new content that's coming out for the Trumponomics course with our big tax lecture. So make sure you're part of that over at meetkevin.com. If you go to meetkevin.com, you'll right away get to see all of that is part of the Meet Kevin membership, and so we'd love to have you there. So focusing now on this Tricolor bankruptcy, not only is Ford looking at riskier borrowers, but Tricolor was famous for this. Look at this line right here. In a bond deal this year, Tricolor disclosed that 68% of its borrowers had no credit score at all, and over half of the Tricolor borrowers had no driver's license. Wait, how are you selling cars to people who don't even have a driver's license? This is a little sus. So we go look at the website for the company and their pitch, which now it says, thank you for visiting Tricolor. We are no longer offering financing, but hey, please continue to make your payments if you owe us money because we're bankrupt and we really need the money. And then the whole pitch here is find the best cars without a credit score or social. It seems like they're purposefully trying to basically lend to illegal immigrants in Texas. And it wouldn't be surprising to me that you cross the border from El Paso, or through El Paso under the Biden administration, and then Tricolor's like, hey, what, no social financing? No problem. All you need is proof of address, proof of income, and ID. Notice how it says you don't need a driver's license. It literally says your passport works. It's because a lot of people will come with a Mexican passport or, a Chinese passport or whatever, and they're looking for a car, which makes sense. You typically need a car in America to get anything done, unlike in Europe where you could get around often with a bike. But look at some of the items that you have on their website. Does a bank provide financing for Tricolor? No, we do it, and we do it without credit or social. Now, it's interesting the way they wrote this, because usually you would say no social security number or without credit or social security number. But by saying without credit or social, it seems to target more of that Hispanic community, which is what this company is known for. You may apply for financing without a credit history, and having a social security number is not a requirement for applying for a loan at Tricolor. It takes about 30 minutes to get an application done, and you can get in for as low as $1,600 with some weird grammatical mistypings on the website here. Now, when we go a little bit further into Yelp reviews for the company, anytime I see Tricolor, I see low reviews, and these are before the bankruptcy. But when we actually go into some of the reviews, listen to this. From 2019, they're doing illegal stuff over there, and we can't corroborate this. This is just a Yelp review from 2019, right? They're doing illegal stuff over there. My son purchased a car, and they knew he was not making enough money, so the lady there doctored the paycheck stub so he could get the car. They catered to the Hispanic community, and they sell garbage, broken down cars. When the car broke down, we tried to make weekly payments of $50. We tried to have the car voluntarily repossessed. They refused. They just wanted their money back, which, in fairness, that makes sense. They are a lender. Salesman came out in Pleasant Grove and spoke almost no English. I could tell he was trying to help, but their pricing was ridiculous. Here's a review I had to translate. It says, I made a huge mistake of allowing a dealership employee to write a positive review on my behalf. She asked me to, and I did while being recorded, signing the electronic contract in the back office. I later deleted the review because it did not reflect my true experience, but they continued to display it on their website without my authorization, even though I already sent them an email demanding they remove it. I was told I could refinance the car later, but when I sought professional advice, they informed me the price of the vehicle was extremely inflated and no reputable bank would finance it for that amount. Clearly, they sold me an overpriced car. Although they say you sign at your own free will, the process was manipulative and pressure-filled. I no longer wanted the car. I left the back office as I was signing the electronic contract to inform them. They made me feel that being afraid was normal and convinced me to continue. Anyway, this goes on. So really what you got is a company that just seems like a blatant fraud. And that's why they're being investigated by the Justice Department. And that's why now, there are reports that they owe $1 billion to over 25,000 creditors. And you can see here being investigated by the Justice Department. This, to me, is not necessarily a sign beyond what we already know that, the bottom 50% of consumers are struggling. But this company going bankrupt, people are wondering, Kevin, is this like a Lehman moment? To me, this is a moment where you have banks purposefully blind to credit risks. And take a look at some of these lines, because it's not just Tricolor, but it's also First Brand Group, which First Brand Group was doing something really interesting where they had invoices or money that they were owed for supplies, for vehicle parts. And then they would basically do a payday advance on those invoices to get money sooner because their credit situation was so crappy. They also are going bankrupt. And so you have people declaring here where these loans have lost like 90% of their value in the span of a day, 90% drop in a day. You have people literally quoting to the Financial Times. The shocking part of it, the investor said, JP Morgan is one of the most sophisticated lenders in the world. How the hell could they have missed this? I'll tell you how they could have missed this. They don't care. JP Morgan is not a great bank. It is a big bank. That's a really big difference, and I think it's really valuable to think about that difference for a moment. Just because you're a big Goliath doesn't make you anything more than a big, fat buffoon. That's my take when it comes to JP Morgan. I actually think a lot of their products and their services are really antiquated. I could rant about them for a long time, but that's just my personal opinion and my experience. So I went to a different, multiple different banks, still bank at large banks as well, but what I've found my most favorite experience has been with a fintech. And I have an affiliate link for them. You should go check it out. meetkevin.com/bank. This is banking done right. Really, really good. Payment processes, ACH processes, wires, all this stuff is free. Like, the fact that they don't charge us for all we use them for is insane, because we use them with House Hack. We're like, how are they not charging us a monthly fee for this? It's crazy, just the services that they offer. We really, really love them. So meetkevin.com/bank. Again, that is an affiliate link, but I'm not like officially sponsored by them. And it's my opinion that JP Morgan sucks. But you have to realize JP Morgan is a giant buffoon who is too big to fail. It's one of the reasons I went to JP Morgan, because I thought, I don't want to be at a smaller bank. I want to be at, a too big to fail bank. But then Jerome Powell basically told us that the entire banking sector and FDIC limits don't matter. We're bailing out everybody. Remember during the banking crisis in 2023? So it really doesn't matter. Like, the Fed's going to backstop the banking industry. It's my opinion, hashtag no guarantees. But the point here that's really interesting is you have like investors that are saying, how could JP Morgan miss this? Because they're dumb. It doesn't matter. They're too big to fail. They don't actually want to look too deep because they want to make the loan. They get their commissions and move on. Who cares? Guess who ends up losing the money? You think JP Morgan really gets left holding the bag? It's all the people buying these bonds. They're the ones who get left holding the bag. What you've really done is you have bankers like JP Morgan put together a pile of crap, and then they securitize it with a AAA rating or whatever, just like, oh my gosh, imagine this, 2008. That's exactly what happened then. Now you might be like, oh, well, Kevin, where's this AAA rating talk coming from? Right here. Tricolor. Despite all you saw about Tricolor with like fraud on Yelp or all these allegations, right? How their website looks, the typos on their website, like all this stuff, and how they're literally bragging about not using credit, which is like, red flag number one that you're going to get people who are probably going to be delinquent. Tricolor had won a pristine AAA rating as it borrowed in credit markets, while First brands may have amassed as much as $10 billion in off-balance sheet financing. Now, these companies didn't report to the SEC. Like, there are a lot of private companies that report financials to the SEC. Like House Hack, we report to the SEC. We report. But there are a lot of private companies that don't. And so this kind of stuff just gets hidden. And now the Financial Times is like, oh, is this a one-off incident, or are there cracks in the credit market? This is going to end up leading others to become more gun-shy. And this is true. This is how the cycle starts, right? The cycle starts with excessive lending, then the frauds go out. When the frauds go out, then investors who thought the big banks had their back start waking up and realizing, man, maybe we don't want to invest in all these crazy credit opportunities that are offering these crazy high yields because they're super high risk. And then you get Columbia University's business school saying, oh, Tricolor's failure could prompt investors to be more cautious. You think? No duh! Ratings agencies will scrutinize deals more, which means the availability of credit may be somewhat reduced. Of course. First Brands is negotiating for rescue financing from lenders to plug an urgent liquidity hole. The debt is selling for just pennies on the dollar. Lenders had poor visibility into invoice-backed financing at First Brands. Yeah, it's a payday loan, bro. Like you don't need a lot of visibility to know that you're going to end up getting burned. It's just straight obvious. But apparently, people are surprised by these styles of loans. Financing technique that allows companies to sell outstanding customer invoices to banks or investors in return for upfront cash. Payday loan. And their actual fundamentals kept mostly private. We don't know. And then the rating agencies, they don't talk to each other. This is just like 2008 all over again, where like you could get an A rating from one because they think you only have one set of debt, but you actually have 3 times as much debt as you're letting on. This is exactly how Bill Hwang got whacked. He ended up being able to leverage like a $20 million portfolio into billions of dollars by going to multiple different banks, pledging the same securities and getting margin loans against the same assets at multiple different banks. Banks don't care. They just want their money, and then they end up getting, burned, and then what? The Fed comes and bails them out. It's basically like crony capitalism for the big banks. And so now, bottom line out of all this, is this Tricolor situation something where like, oh my gosh, I'm like nervous, this could be bad for the whole market? No, because there's so much greed in markets right now that it doesn't really matter. Okay, who cares? Like, they made a little poopsie doopsies. These companies are going to go bankrupt. Everybody's going to forget about them in 6 months, and it's not going to matter. The only way it matters is if credit standards really start tightening up. And frankly, it's not likely to happen because you've got companies like Oracle or other companies that are now financing against NVIDIA chips. I mean, Oracle literally just this morning came out with a 7-part series of unsecured notes. These aren't convertibles. These are just straight debt. At about 134 basis point premium over the equivalent treasuries. 5-year note, 7-year note, 10-year note, 20-year note, 30-year note. I think they even got a 50-year note. They got a bunch of notes because they're financing to borrow. It will end in a giant collapse one day. The thing is, nobody knows when. But right now, we're still in this environment of massive greed and the accumulation of debt where, some of these frauds going BK, gets written off and people move on. But the too big to fail button is going to come again, and history is going to look just like 2008 again. Is it a sign that the bubble is popping now? No. Is it concerning that debt markets can write off an investment 90% in a day, like we saw with Tricolor? Yes. That's wild. I mean, they're not even going to reorganization. The fact that they're going straight to liquidation is scary. See, Chapter 7 trustees are required by statute to move fast, unlike Chapter 11. The speed can mean selling assets at a discount, potentially reducing what creditors get back. Sure, well, you're also going to sandbag, the valuation of these used cars, which if a lot of them were being sold to illegal immigrants, it does make you wonder if a lot of them are just being deported. And the reason they're not able to make their payments is because they got deported. So it could be Trump's fault. This could just be the perfect storm for Tricolor, but not necessarily, in my opinion, a, massive systemic risk of some sort.
Knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.